The United States continues to lead the world in total COVID-19 cases. And over 55 million Americans have filed jobless claims since March. Yet US stocks continue to rally and hit new records. Analysts have many theories to explain this disconnect. But one factor which they all agree on is the actions taken by the US Federal Reserve.
Essentially, the governments have come in and provided kind of like a backstop to prevent bankruptcies, to prevent layoffs, which is quite unprecedented actually compared to previous crises. So that's one of the reasons why possibly asset markets have held up, because if you do see a lot of bankruptcies and layoffs, then obviously you would see a drop in asset prices as well because you have forced sales happening, right? So that's the unique thing about this current crisis.
Leading the way are technology stocks, the so-called FANG stocks. They are Facebook, Amazon, Apple, Netflix and Google. But while these stocks on the S&P 500 have outperformed, the rest of the index is in fact down 5 to 7%. Some analysts have voiced concerns about the gap between Wall Street and Main Street.
The tech companies are now 30% of the S&P 500. And because the S&P is a market cap weighted index, it only reflects the big corporates in there. And you have $2 trillion companies in there. Whereas the 90% of the US economy is actually small to medium-sized enterprises. So in other words, if I were to reconstruct the S&P 500 into one that reflects the small and medium-sized businesses only, that index at this point in time would probably be down about 50 to 55%. In a reflection, which is an accurate reflection of what's happening in the general economy. So the stock market is really not reflecting what we're actually seeing or feeling on the ground in the US at this point in time.
But despite these concerns, analysts agree that it is unlikely that we're seeing another tech bubble like the one seen in the early 2000s.
We don't believe we're in a bubble territory yet. I mean, so it actually is quite normal for a few stocks to lead a recovery. I mean, we did see a change to the inflation outlook, to the interest rate outlook. Then ex post, it could look like a bubble, but we really don't see that happening. Unemployment is still extremely high. Therefore, wage pressures are going to be very minimal. And that should allow the central bank to keep interest rates low in the US. And a weaker dollar should allow that to happen globally as well.
Of course, no bull run can go on indefinitely. And the question on investors' minds right now is whether this one has run its course.
If you're talking about the peak of the share prices of the tech companies, I think we are quite near there. In fact, we need another quarter of very strong results before the prices can actually go up further. So the prices need to be boosted by earnings growth from here on. In terms of the overall market, whether we think that there might be a correction or whether the market can actually go up further, the other sectors need to actually get into the act. And by that, we mean that the value sectors, the cyclical stocks, consumer discretionary, healthcare, technology, etc., need to actually boost up their earnings, need to actually boost up performance for the index to actually pick up another 8 to 10% returns. And that could probably come when we get a vaccine announcement in the US or in Europe itself. That will be the booster for these value and cyclical stocks to run. And that in turn is likely to pull the index up another leg. So on a short-term basis, we're actually very positive and constructive on the equities market. And we do think that we are primed for another 8 to 10% return.
Analysts are also keeping a close eye on the COVID-19 pandemic and in particular, the scramble to find a vaccine.
So the big question here is how much of this is already priced into markets? We've seen a very sharp V-shaped recovery in equity markets. We haven't really seen that in the broader economy yet, but equity markets tend to lead the broader economy on a kind of like 6-month basis. So that suggests that market is kind of pricing in a recovery in the broader economy. Of course, there's a lot of skepticism that that's going to happen at this point in time because you still see that the COVID cases that are being announced in various parts of the world, some countries are still grappling with it and haven't got the situation under control. So there are huge question marks in that regard.
Analysts say the best advice for investors right now is to continue to diversify their portfolio and maintain longer outlooks.
Don't just pick one stock and invest in it. Try and diversify across different asset classes, across different regions. Just try and play the long game here. I think that is really important. The second thing is, there's a big fear out there about what if I invest today and then the markets go down. So manage your emotions in that regard. I think it's really important to say, yes, markets might go down tomorrow. They might go down over the next 1, 2, 3 months. But if you look over time, investing relative to cash does much better. And indeed, if you listen to policymakers now, what they're effectively saying is, we want inflation above interest rates, and we want them actually above bond yields, government bond yields. That means that if you're investing purely in cash, in deposits, and also in government bond yields, you're likely to lose purchasing power.
And the other tip is not to jump on the bandwagon just because everyone is talking about a particular stock. Sometimes less popular may not necessarily be a bad thing.
So I won't be chasing tech, for example, at this point in time in the cycle. But that's not to say that you avoid it completely. So investors who don't have any exposure in tech, you probably watch the levels. If it comes off a bit, maybe that's opportunity to go and get some exposure to that particular sector. But if you flip it around, there are areas, for example, as I said, in the laggards, in the financials, for example, even in energy, which is a bit bombed out. There could be opportunities to actually slowly get exposure to those areas